Hey, lately I've been getting a question from a lot of federal employees that sounds something like this. Now that tax rates are permanent, does that mean Roth conversions are basically off the table? And on the surface, that sounds like a fair question. If tax rates are locked in and there's no scheduled sunset anymore, why would we still be worried about shifting money from traditional to Roth? But for most federal retirees, that assumption can be very misleading. And today I want to explain why permanent tax rates do not eliminate the need for tax planning, especially in federal retirement. Welcome to the Federal Retirement Channel, the place federal employees come to get retirement right. Hey, my name is Mel Stubbs. I'm a financial planner with Christy Capital Management, where we help federal employees plan for retirement. If you need individualized help, go to christycapital.com and click Talk to an Advisor. So first, let's clear something up. When people hear that tax rates are permanent, they assume that means tax rates are guaranteed. They are not. Permanent simply means that there's no expiration date written into the law. Congress can still change tax brackets, raise rates, lower rates, adjust deductions, or introduce new rules at any time. We've seen this happen repeatedly over the years. So while there's no scheduled increase right now, nothing about tax policy is ever locked forever. But here's the more important point. Even if tax rates never go up again, that doesn't mean that your taxes will stay low in retirement. And this is where federal retirees are different. Most federal employees retire with something that most Americans do not have. They retire with multiple guaranteed income streams. You've got a pension that includes cost of living adjustments. You've got Social Security, which adjusts over time as well. And for most people we talk to, you've got a rather large TSP balance, and it's traditional. And what most federal retirees do not have is large Roth balances. So when retirement starts, taxes often look reasonable. But over time, income tends to rise, not fall. And that surprises a lot of people. So let's talk about why income often increases in retirement. First, there's cost of living adjustments. Your pension increases, your Social Security increases. But tax brackets and Medicare thresholds don't always keep up the same way. Second, there's required minimum distributions. Once RMDs begin, the IRS forces money out of your TSP whether you need it or not. And if that account has grown for years and years, those distributions can be much larger than people expect. Third, the death of a spouse. This is one of the biggest blind spots in retirement planning. When one spouse passes away, income often stays similar, but the tax filing status changes from married to single. So similar income now fills up higher tax brackets much faster. Nothing went wrong, no bad decisions were made, the system simply changed around you. Now let's add Medicare into the picture. Medicare premiums are based on income, and once you cross certain thresholds, your premiums increase. So higher income later in retirement can mean higher healthcare costs as well. And this is why timing matters so much. Income spikes after Medicare can cost you more than just the income taxes. They can cost you thousands more per year in Medicare premiums as well. So this is why Roth conversions are not about predicting future tax rates. They're about managing the taxability of your future income. We all want income in retirement. Nobody is trying to plan for low income. What most people are trying to do is avoid unnecessary taxable income. The goal is not less income. The goal is less income showing up on your tax return. Doing tax planning earlier allows you to control when income shows up. Waiting often means the IRS controls it for you later. Shifting money from traditional to Roth before your required minimum distributions begin can reduce future forced income. It can also help protect a surviving spouse. It can lower lifetime taxes even if tax rates never increase. And it can reduce the chance of higher Medicare premiums later on. This is especially important in the years before Medicare, when income planning has fewer consequences. So permanent tax rates do not eliminate the need for Roth conversions. For federal retirees, they make intentional tax planning even more important. This is not about guessing what Congress will do. It's about understanding how pensions, Social Security, RMDs, and Medicare interact over time. The goal is not to pay zero taxes. The goal is to avoid paying unnecessary taxes later when you have fewer options. If you need individualized help, go to christycapital.com and click Talk to an Advisor. And if you want to watch another video about your TSP, click right here. My name is Mel Stubbs. I'll see you on the next video.